And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA Corporate and Investment Banking. ABSA is a proud lead sponsor of B20 South Africa 2025. Good evening. Welcome to the program. And there's quite a lot to get through today. Very interesting results from Telkom, very interesting results from Premier Food. But I do just want to start with what I think is probably the big kind of debating point of the day. It comes from Gerrie Fourie, the CEO at Capitec. We were expecting to speak to him this evening. We understand that someone from Capitec will represent him instead now. But his suggestion, and well done to Business Live for asking him the question. I don't know how they got to it. But he essentially says that we are defining unemployment in the wrong way. And if you paid any attention at all, you'll know, and I've said this many times, unemployment is the biggest long-term problem that we face. And it is the unemployment rate is at around 32%, give or take. We call it about 10 to 12 million, depending on which definition you pick. But he's suggesting that actually people who are performing a service or making a product and receiving an income in the informal sector should be counted as employed. And he makes what I think is an interesting point. He says that if it is true that our unemployment rate, if 32% of the country were getting no income, well, there would have been, I think the word he used was unrest, but let's just use the word violence. It's sort of the same thing. And I mean, in one level, to redefine employment, employed, unemployed means nothing. But if you don't define it properly, you don't focus on what you should be focusing on. So, to put this another way, maybe the focus has been over the last 30 years to try and create jobs in the formal sector. That's fine. No argument with that. But maybe we should change the angle of our focus slightly and say what we should be doing is trying to help as many people grow whatever income they have. Do you see the difference? I mean, the one is the formal sector, employment contracts, medical aid, etc., etc., etc. The other is just, doesn't matter what income you're earning, we're trying to get you to basically be in a situation where you get more of it. So if you're on the side of the road, as so many people are, and if you're driving in a car right now, this is probably the first night of the year or the second or third night of the year, you won't see someone at a traffic light, or you won't see someone with a board saying, I'll do any job. Or if you go to a hardware store in a middle-class area, you will see someone saying, can I do this for you, whatever it is. Now, basically what we should be doing, perhaps, is trying to help those people get as much money as possible, and they would be in the informal sector. And this gets to the heart of another thing, which is the definition of a job. Is it a job under the Labour Relations Act, or is it a job you do this and therefore you receive this in return, some form of monetary payment? There's a lot to this, and I'm looking forward to this conversation, if only because so many of our debates around unemployment have been quite so stale. And I know this has been raised before, this issue, but still, I do think it's very interesting. I should mention, by the way, that Parks Tau, the Minister of Trade, Industry and Competition in Parliament, said he supported what Gerrie Fourie was suggesting. We'll talk more about it, of course, in about 20 minutes. But first, we'll talk about Telkom, and then just looking at some of the numbers involved with Premier Foods. They're building bakeries that will produce together, two of them will each produce in the same facility 8,000 loaves of bread an hour. It's an astonishing amount. There's another one, though, from a rival of theirs that's going to produce 12,000. The science of that will be on your Money Show this evening. Good to hear from you. 011 883 0702 021 446 0567. Voice notes this evening on 072 702 1702.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Well, Telkom reporting today it grew its subscriber base by more than 13%, was able to increase headline earnings by 44% per share in the year to the end of March, declaring a special dividend for the first time in 4 years. The company also saying data revenue, now well over half the money that comes in its fiber business, seems to be doing very well as well. Nonku Dlamini is the Chief Financial Officer, the Group Chief Financial Officer, I should say, at Telkom. Nonku, good evening, and thank you for the time. You had a 10% increase in revenue from consumer mobile services. Are people spending more time on their phones and thus using more data? Is that helping to drive this change?
Good evening, Stephen, and to your listeners. Indeed, we've seen great performance in the financial year that we are reporting on today. And largely it's driven by the strategy that we call a data-led strategy. And yes, data is actually the new currency because a lot of things are happening through data, and we've seen the impact of that in our performance, as you indicate, our 10.2% growth coming just from the mobile service revenue.
So, I mean, you increase your subscriber base by 13%. I mean, that's an amazing metric. Are people moving to your network from other networks? Are they using multiple SIMs from different networks for different devices? Are you finding that people are just consuming a lot more data? And I imagine most people are, if only because the phones we use now take much more data more quickly.
Yes, so the growth that we've seen in the subscriber base, we've got a combination of our postpaid customers as well as prepaid customers. And the focus really is indeed the utilization of data, and the SIM approach is where people would have a SIM card from Telkom, and because of our value proposition that we believe is quite cost effective, we've seen that increase coming through both from the subscriber base as well as the revenue.
Are you finding, and I'm sure you find this, that people don't make nearly as many as normal calls? I think we now call them voice legacy calls as they did. They call on WhatsApp instead. That is cheaper for most people. Often also they're in a Wi-Fi area, their own, or perhaps a work Wi-Fi or something. How is that affecting your revenues?
You're very correct, Stephen, because when we look at our revenue makeup, significantly the growth of the mobile business is coming from data revenue, which grew 12.3%. But if you look at the voice-related growth, it's only 1%, which basically confirms that people are largely using data to make calls and for other activities. Wi-Fi in their homes, and it's really a shift from the voice utilization to the data utilization of our services.
Is it having an overall impact on your revenue, though? I mean, you still have to obviously keep the voice call function working at a time when it's going to get used less and less.
Yes, we still have to keep that open, but I think our focus is to ensure that in terms of the utilization of data, we have enough availability. And in fact, we've been working on extending our footprint with regards to our base stations and the use of fiber. We are the backbone, in fact, in the country in the utilization of fiber. And the fiber to the home means that we are expecting more data utilization just through the growth that will come from the laying of fiber across, and that will be the utilization of data from our services.
So, I mean, I get all of that, and obviously that is the future, and it's unstoppable, and it's going to happen. I do wonder, though, if you and other cell phone companies are actually going to start to lose money because people over time will just give up their voice plans. They won't have legacy voice calls at all. And that's made a lot of money for you.
In the past, indeed, but I think you have to look at it from the volume perspective as well, in that as much as you may well have a reduction in the voice calls, the volume of data, both for calling and all the other requirements, is actually what's going to drive the top line in revenue in rands and cents. So it may well be that if you look at it, the voice couldn't do as many things as the data is basically being able to be used for. So we're quite comfortable, and it's moving with the times. It is what it is, and we have to adapt and make sure that we are part of the future, which will be data-driven and data-led.
This has been a very strong update, and your board seems quite confident that this momentum will continue. There's going to be strong demand for the kind of services that you provide for a long time, and I imagine that'll be the dominant trend, greater demand for data, especially with 5G and things. Are there any other trends that you're seeing in this industry at the moment?
The data utilization for us is going to be still a focus and the core of our strategy going forward. The focus is to also make sure that we spread our footprint, because you've got other regions that may not be getting as much served as we would want to. And I think the focus for us is to ensure that we capture the markets that may not be receiving as much attention. Yes, there would be a future that will be different with the AI and other elements in terms of, the streams that are available. But again, in those instances, we will basically make sure we are part of the future that will take different shapes. There may be changes into the future, but for now, our focus is to extend the footprint that we have. We're the backbone, Stephen. If you look at it, we always say if you are not using Telkom, you are using someone that is buying from Telkom.
Nonku Dlamini, thanks very much indeed. Interesting point. The Group Chief Financial Officer at Telkom.
7:02. Stephen is on The Money Show.
6 to 8 p.m.
The Premier Food Group reporting today its operating profit up nearly 17%. Its revenues were up by 7% in the year to the end of March. The group saying lower global wheat prices and then soft maize trading caused by record high maize prices made it hard to grow revenue further, but its mill-bake division increased revenue by nearly 6%. Kobus Gertenbach is the CEO at Premier Foods. Kobus, good evening. Thanks for your time on The Money Show. How big a factor was these very high maize prices for you over the course of the year?
Good evening, Stephen. It certainly, I think, affected everybody that plays within the maize space. I mean, when prices really rocketed up on the back of very dry farming conditions last year in southern Africa, and South Africa became the breadbasket that fed a lot of our neighboring countries, we just had to pay a lot more for raw maize. And I think, unfortunately, our consumers also had to bear the brunt of it. And that leads to lower margins and also certainly decline in volumes as maize meal became very expensive. But luckily we're through that now and we're into the new season maize and consumers have gotten significant relief from that.
You report today that your mill-bake division did well. There was a focus on efficiencies. You've upgraded several bakeries and wheat mills. Is there much more scope for savings? I mean, at some point you can't get much more efficient.
That is probably true, but in my lifetime, I haven't reached that point yet. And we certainly are making the investments. We've shut down our Ayrton bakery, which is really situated in the middle of the biggest bread market in South Africa, in southern Gauteng, about 2 years ago. And we've been rebuilding that. It's been a 700 million rand investment project for us. And we're looking forward to that bakery coming on stream in October, November timeframe, and the efficiencies that we'll gain from that will certainly give us another leg up again.
I'm no expert on the science of baking bread, Kobus. I'll leave that to you. But I did notice you're going to have 2 lines that will bake 8,000 loaves of bread, each one of your competitors. You know the one. They're building plants that will bake 12,000 loaves an hour. Is there a saving or a benefit or an efficiency one way or another? I mean, does it cost as much per loaf to make 8,000 an hour as it does 12,000 an hour?
Well, I think that once you're at that level of scale, the returns are certainly diminishing, and I wouldn't really put any significant saving on of 12,000 versus 8,000. I think once you've got that type of facility and you can bake brown bread on the one and you pretty much run 24/7 and you bake white bread on the other one 24/7, your efficiency is already quite significant on the 8,000 lines. And we're very comfortable with that being the most optimal for us, for our type of facilities that we want to do. And, the 12,000 lines have never been implemented in South Africa. There's a few running in Saudi Arabia. And one will have to see whether that really does deliver further returns.
I mean, volume does matter, though, doesn't it? I mean, the more loaves of bread you have in the supermarket, the more you sell. It's a bit like, I don't know, petrol or, the detergent wars that so many companies have been involved in.
No, that's true. At the end of the day, we the biggest baker in the country by far are now Premier, and we've got the facilities to back that up. And really, Ayrton is the last part of our footprint that we need to get that type of quality implemented. But these big bakeries are also, if you have a breakdown, then you've got 12,000 loaves an hour of dough coming at you. So there's lots of different things to also consider.
Interesting way to look at it. I mean, I don't know much about the history history of bread, but my understanding of it is that until probably the early 1950s, the price of bread was quite high. There was no great production facilities. Each bakery would basically make as many as they could. And it also didn't last very long. It would last a day or two. Now, of course, it's completely different. You talk about, when we're talking about the volume that you're talking about, are we at the sort of peak science of baking bread? Can it really get faster or cheaper than it is now?
Well, I think that one mustn't just focus on the production process. I mean, we certainly have introduced robotics and things like that, where the handling of the bread in the baking process is also diminished a lot in terms of human intervention. But it's also the speed at which you can then distribute out into the market. And you must also remember that it's all about the handling of the bread also causes damages. And, if you look at these large-scale new state-of-the-art facilities, your production efficiencies is not just your energy usage, but it's also the fact that you almost have no deficiencies in your process. And if you combine that with a highly efficient distribution network and sales infrastructure, it's really an end-to-end optimization of the whole value chain. And I think that there's always more opportunities in that.
You had some problems in Mozambique through the year and your operations were affected. And as part of that, as I understand it, you pushed more product to the informal sector. So you left the formal sector, or you pushed less to the formal sector and more to the informal sector. Did you lose much money when you did that? I'm trying to get to whether or not for consumers, the informal or the informal sector is cheaper.
Well, I think at the end of the day, we try extremely hard to make sure that we serve all the consumers evenly. Certainly, the informal sector has got a higher cost of doing business. You've got smaller drops. You have to handle cash. That's got cost implications. And we've been very careful to make sure that we don't favor one channel over another in terms of profitability. From a Mozambican perspective in particular, I mean, it was just really a very difficult trading environment. You had the political unrest, and the unrest really resulted in the looting and theft and burn down of a lot of stores in the formal space. And so ultimately, in order to get the product out, you have unrest for a month, and then suddenly everybody is worried about where people are going to get food to eat. And from our learnings in the KZN floods and the KZN riots and so forth, we're fairly well accustomed to deal with these crisis situations. And the fastest way to get the product out to our consumers is really to get it to the endpoints of distribution, which is your informal stores. And it's really what we managed to do within the Mozambican market in the aftermath after the unrest subsided.
Kobus Rottenbach, thanks very much indeed. Really appreciate that. CEO at Premier Foods.
The Money Show.
The Markets.
Ryan Hill is the head of fundamental sales at Absa CIB. Ryan, good evening. I mean, what an amazing day for Telkom. They ended up nearly 8%. Very strong results from them. And you heard their chief financial officer a few moments ago.
Oh, absolutely. Thanks, Stephen. Good to be on the show again. As you say, I mean, pretty much the market very encouraged by a couple of things. One was that they had very strong revenue and operating profit levels. In fact, those were certainly better than what the market was expecting. I think investors were also very encouraged by their strong cash flows. And to be honest, those were partly flattered by the fact that they had some property disposals. And of course, that then supported their decision to declare a special dividend on top of the ordinary dividend. So, yep, as you say, lots of strong demand out there for what seems to be a story that continues to improve.
Sasol up nicely today, up nearly 4%, and that, I presume, related to the oil price, which was up slightly, and surprisingly in a way, because of all of the trouble around OPEC+.
I know. I mean, there are all kinds of headlines, and I guess this is a case of, perhaps choosing the story that you want to tell at the moment. So, just for some context, we saw oil bottom out at around $63 in the early part of this month, now closing in on $70. And to your point, I mean, there's both positive and negative headlines. But just looking at some of the more positive headlines, it sounds as though there continues to be a bit of optimism around the China-US deal, which of course would support global growth and hence demand for oil. But then we're also seeing that the EU continues to place pressure on the use of Russian crude and refined products, which again suggests that the market potentially could be tighter than initially expected. But ultimately Sasol largely being driven by oil prices. Yeah, I mean they had a capital markets day recently in which they of course, spelt out some strategic initiatives and some fairly aggressive plans as far as operating profit guidance was concerned a couple of years out. But again, as I say, the tailwinds right now are pretty much just driven by the oil price.
And then the industrial group, KAP, I mean, a really tough day for them. They did say they'll report lower full-year earnings.
Yeah, that stock got smashed 22% down on the day. Very disappointing 11-month trading update that they came up with. They pretty much warned the market that they're going to see headline earnings declining by more than 30%. To put that in context, we as a house were forecasting, our analysts were forecasting a fall of closer to 11%. So big gap between our expectations and the reality. And of course, it does seem as though the business largely dragged lower, I should say, by lower margins in some of the key operations like the MDF business, for example. So even though they were seeing better volumes in that business, margins certainly came under a fair amount of pressure.
And then clothing retailers, I mean, quite a few of them, Woolies, Mr. Price, the Foschini Group, all down. They were down yesterday as well. And yet the Foschini Group and Mr. Price had quite, what I thought were quite strong results on Friday.
No, absolutely. So I think context is everything, right? So as you say, all down around 2% today. And in fact, to your very point, I mean, all of them have recently been producing updated performance numbers, which suggest that actually things are looking quite decent. However, I think one must bear in mind that these operational updates that we're seeing at the moment are being compared with a very soft period 1 year ago. Remember last year we had a very late start to winter. So the volumes last year were pretty much quite depressed, and so current trading is going to look comparatively better. But also, you know, for bigger picture context, these stocks are still down about 20 to 25% from their December highs. And it does seem, just looking at the numbers on Bloomberg, for example, that the sell side continues to downgrade earnings forecasts. And I gather that's partly because the consumer environment in SA still looks to be quite weak. So I think investors are going to have to see much more compelling consumer data for investors to start buying back into these stocks again.
Ryan Hill, thanks very much indeed. Head of Fundamental Sales at ABSA CIB. You're with The Money Show, just gone 6:30.
Travel is more than just ticking off countries. It's about the people, the culture, the food, the moments. I'm Pippa Hudson, and on Wonder the World, I invite you to join me every week as we explore destinations both near and far, with the help of fellow adventurers who share their unique travel stories. Listen to my podcast wherever you get them.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
17 minutes to 7 the time. Well, I don't know if you've been following... I don't know what the right word is to describe what's going on at the Road Accident Fund at the moment. I mean, it just looks like a disaster, a tragicomedy of some kind. There's been an argument about all things accounting standards for the last couple of years. Collins Letswalo was the CEO. He was, we were told, on special leave. Then we were told he was suspended. Well, I think he is suspended. As I understand it, the Transport Minister, Barbara Creasy, then said she was calling I quite like this detail, physical meeting of the board. Good. Sometimes you do need to look people in the face, so eye to eye, and say, what on earth is going on here? But at the bottom of it all, it doesn't matter what you have to say about Collins Letswalo or anyone else, is that I think we have to admit that the current model of the Road Accident Fund is broken. There was a High Court judge in Tshwane who said, I think it was yesterday, that the Road Accident Fund's approach to litigation was chaotic. And that's because they just don't reply to legal writs. I mean, if I got something from a lawyer basically saying, you know, or an order from a court or from a judge or something, I would panic. But it's become so normal for the Road Accident Fund. No one does anything. And I mean, nothing tells you more about how broken it is than just that. And that really makes me think, actually, we need to start again, and someone will get on their rights, and Collins Letswalo or maybe the board, maybe I'm being unfair, but will say, no, we don't want to lose our job or whatever it is, and they'll go to court. But come on, let's just start again with this thing, because it is not working. And you can blame Letswalo, I think, for quite a few things. You can't blame him for the fact that it's not working in terms of the model. I mean, he sort of took a poison chalice, really. There is so much to look at it, and the current system just isn't working. Maybe you've been at the brunt of that. 011 883 0702 021 446 0567.
7:02.
7:02.
Stephen is on The Money Show.
6 to 8 p.m.
A fascinating suggestion today from the CEO at Capitec, Gerrie Fourie, that we should redefine what we mean by unemployed. He suggests we should include people who work in the informal sector in the category of employed rather than unemployed. That first report was published on Business Live this morning. Then this afternoon in Parliament, the DTIC Minister Parks Tau suggested that actually he agrees with Fourie. Well, François Viviers is the Marketing Communications Head at Capitec. François, good evening to you. How exactly would you describe, or would Gerrie Fourie describe, the definition of unemployment in South Africa right now?
Good evening, Stephen, and good evening, listeners. I think it's important to start by why we made this statement, and specifically why Gerrie highlighted it. We can all agree that we really need to work together to help South Africa grow. We've got a big challenge, but also a big opportunity in this country to drive and to collectively work to drive growth. But in order to do that, we really have to understand what is the true nature of the economy so that we can tackle the challenges and barriers to growth. And what Gerrie was explaining was that what we see in stats is a statistics, and specifically the way that employment is measured, and what we see in some other market research as well as our own client data does not stack up. We see a lot more activity in the informal economy, specifically the township economy, across all sectors that is driving economic behavior. And we think that if that's properly understood, then collectively we can work together as regulators, as government, and as private sector to say, how do we enable those industries to grow further?
I mean, some of this is common sense, right? There will be people who provide all sorts of services in township areas, haircutting, beautician, washing cars, fixing things, whatever it is. They will be receiving money from it. They have an income. It's pretty sustainable in many cases. They basically, to all intents and purposes, have a job. They just don't have an employment contract or a certificate of registration as a company.
100%. And that comes into the way that the research is being done. So Stats SA follow quite a sound research methodology, but what we find is typically in the way that research is being done, they might not be reaching the right people, but also the way that the questions are asked is not inclusive of the informal economy. So typically Stats SA currently reports 33% unemployment rate out of a base of about 25 million people who are defined as employable. And 2.9 million is regarded as the informal sector. But then a recent study by FinScope, and this is the 23 study, I know the 24 one recently came out as well. In that study, they quoted that 71% of 5 million SMEs are in fact informal, which means it's not a registered business. They do not pay tax, but they are a business that is operating and employing people. And the impact of that is they estimate 2.3 trillion rand and impact on 10 million people in terms of employment. Now, if you stack up that 2.9 million to the 10 million, you can see there's a big difference. Similarly, in our own data, so looking at 24 million banking clients, of which 8.8 million are deemed to be fully banked clients based on their income and their banking behavior, we measure that about 3 million or 33% of them are in fact earning an income that is not related to a salary. And that typically is informal employment. And 1 million of them, in fact, we are very sure are running a proper business by virtue of looking at the nature of the transactions as well as potentially the way that they receive their income. Now, that paints a very different story to what we see in the official statistics. We further do quite a lot of work with G.G. Alcock, and I had a conversation with him earlier today, and he confirmed again that he estimates the real unemployment rate to be between 12 and 15%. And we don't think it's necessary to debate whether it's 10 or 12 or 15, but rather the principle, and that we should look different at this economy and look at how can we empower them to grow. And that's really the conversation we should have. So there was another study done by Harvard and UCT a couple of years back that estimated that the unemployment rate would have been 17% in 2019 instead of 29% if the informal sector was properly supported. And that's the debate that we need to have. How do we change regulations? How do we recognize them? How do we provide credit and funding in the right way? And how do we provide support that unlocks the potential of this economy?
So, I mean, the risk... Okay, so on one level, if we change the definition of employed and unemployed, it doesn't do anything. It doesn't change anyone. We just talk about a different number. But what we might have been doing is focusing on the wrong thing. And I made this point at the start of the program that we may have been trying to create formal jobs. That's been the aim. That's the aim of, say, the Youth Employment Service, things like that. I mean, a noble aim. I fully back them. When really what we want to do is to make the people who are currently working richer. Or to put it another way, what we really want to do is to reduce poverty. And is the risk that we've been focusing on the wrong thing, creating formal jobs, when we should be focusing on creating incomes and reducing poverty?
100%. That is exactly the narrative. And we think that there are some positive stories to share. A lot of this we've seen when we actually walk the streets. And earlier last week, I spent time in Mpumalanga and Limpopo in areas where you could see a lot of activity in the street. And some of these are people vending vetkoek or selling vegetables. And we know out of our own data that they easily turn around 15,000 Rand a month. We know that some people use some form of income, potentially even a social grant income, to buy bricks and mortar, build an extra room in their house, and that extra room they could rent out for 3,500 Rand. Now that's passive income that they would not declare as a job, but that income is enabling growth. And I think what is really important for us as a bank as well is to say, if we want to help that part of the economy to grow, we should provide them ways of translating their commerce into digital currency, so into electronic payments, so that we can understand the behavior, we can understand their inflows, and use that data on which to provide credit. And that credit could be used to increase their grow their business, grow their turnover, and ultimately create employment opportunities. A big handicap for a bank, though, is the capital adequacy requirements. So to provide credit to someone without security at that level is quite expensive, and better regulations geared for the informal economy could help us to do that better.
Sure. There's another issue around this, which is that the formal sector is regulated, often says it's tightly regulated. The informal sector is not really regulated. Is that, as soon as we start to talk about changing the distinction, that kind of argument matters, and many people believe the formal sector is too tightly regulated.
I suppose that's an important conversation to have, but the problem is at the moment we're not having that conversation. We don't see the real data. We're very much in favor of stimulating the economy as much as possible on all sides, both formal and informal sector, and to create the space and the opportunity to do so, we need the right data. We need to start by saying what's the real economy in South Africa. What are the real challenges, and how do we work together to unblock that?
François Viviers, thanks very much indeed. Really do appreciate the time. Head of Marketing and Communication at Capitec. There are a lot of different directions for this debate to go, but I'd really like to hear your view, whether we should change the definition. I'm sure someone who is not formally employed and is working, if you were to ask them, and I haven't been in that position, but if you were to ask them, someone who is washing cars or cutting hair, is going to say, I'm not unemployed. I would suspect that might be what they would tell you. 011 883 0702 021 446 0567. The Money Show with Stephen Grootes is brought to you by ABSA Corporate and Investment Banking. ABSA is a proud lead sponsor of B20 South Africa 2025.
702 with Stephen Grootes.
Email him on stephen@702.co.za.
Well, there's been quite a lot of volatility in cryptocurrencies, and some more than others over the last few months, all sparked, of course, by the election of, well, you know who. But many investors, I think quite rightly, this basically turns them off. However, what we're beginning to see is an increase in the use of what are called stable coins, cryptocurrencies backed up by a normal currency. Karel de Jager is the CEO of Sixpence, a blockchain software company. Karel, good evening. How does a stable coin work?
The stablecoin works just like all of the other cryptocurrencies. It inherits all of the magic of the blockchain, which means that it's censorship resistant, you can send it around, and it's quite easy to open an account and so on. but it removes all of the volatility that is typically associated with currencies like Bitcoin, for example, because it's pegged to the US dollar typically. So one coin is always worth $1, and it can actually not, fluctuate in value. So then it actually becomes extremely useful. Because now, you can't really transact with Bitcoin, because if you buy a bread with a Bitcoin today, then tomorrow the bread might be half of the price or double the price because it's so extremely volatile. But now you can actually use it as a means of exchange and as a means of payments.
Okay, so I mean, I get that, and I can see the use in that, but isn't the major selling point of a cryptocurrency that its value cannot be controlled by a bank, whether the Reserve Bank or the US Federal Reserve? So if it's tied to a normal currency, okay, you get the value of you get the magic of the blockchain, as you call it, or the maths of the blockchain, but the value is still, particularly with the dollar, quite volatile. So kind of, let me put it another way. What's the sort of point of using it if its value is going to go up and down with a currency you could use instead?
Yeah, so it loses that attribute. I 100% agree with you. But it gains a number of other attributes. If you compare, for example, payments to like what we are used to, I agree with you. Like if you walk into a shop and you tap your phone and you buy some milk and some bread, there's nothing that can really beat that experience, right? Cryptocurrencies, stable coins, I don't think that it can really improve on that. But if you think about remittances, for example, cross-border transactions, then there's lots of room for disruption. That's a horrible experience, and that's where stablecoins actually play a big role, because I can now send money across borders and it's settled immediately, and it's virtually at no cost. And we actually see it in the numbers. On the conservative end, it's the amount of volume that's being transacted with stablecoins is north of $7 trillion a year. That's more than Visa and MasterCard combined. So you have to ask yourself, if that is the case, and people obviously don't hold it for speculation because it won't go up.
Sure.
If that's the case, it's really used as a utility. Yeah.
Okay, sorry to interrupt. I have one last question. We're going to run out of time. And this is a very technical question. How does the backing work? So in the old days, let's say the 1930s, 10 Rand in notes meant 10 Rand worth of gold stored somewhere. It was called the gold standard. You could make a claim for that gold if you had, say, 10 Rand in stablecoin. Now, in stablecoin, how is it tied to the value of the currency? Or is it just an artificial math thing and it doesn't matter?
It's a very important question. It is typically backed by cash instruments or US dollar treasuries, mostly US dollar treasuries usually. So it's a very safe backing, and you do expect, every user expects, and it needs to be that for every coin that is in circulation, there is $1 in either in a U.S. Treasury investment or in cash in the bank, and that is actually a very contentious point as well, because the largest stablecoin issuer, Tether, never actually released an audit report. The second largest stablecoin, Circle, they actually do release very quarterly audit reports showing that the assets do actually exist and that it's more than the circulating coins, which is now, of course, the liability, and therefore they are solvent. But it's an important point. You have to actually trust the issuer that they do actually have all of those dollars sitting in an account somewhere.
I mean, when you have something like Tether that you say never issued an audit report, I mean, it sounds to me like a scam. Sorry to be so conservative.
Yeah, so that's perfectly possible, and there's lots of people that believe that. But if you look at Tether, it's been around for 10 years. They have 150 billion stable coins in circulation.
With no audit report. I mean, wow.
As controversial as they are, it's people actually, there's a huge demand for it. It's used all over the world, especially in sub-Saharan Africa.
Yes, no, I know that. Karel de Jager, thanks very much indeed. CEO of Sixpence, a blockchain software company. Someone's put $150 billion into something with no audit report. Okay, with The Money Show, 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking. Absa is a proud lead sponsor of B20 South Africa 2025.
Good evening, you're with The Money Show. I'm Stephen Grootes. Plenty going on. We'll talk more about the green economy, bit of a fractured environment around it in just a moment. Rotendo Hundwengui, of course, updating you on what's happening around our continent. But Warren Ingram, I think he's poking the bear a little bit because I am a homeowner. I mean, by homeowner, I mean I pay money to a bank every month. And he is sparking the debate a little bit about whether or not you should rent or whether you should buy. And I've been interested by this. I'm one of those people who sort of grew up in a get on the property ladder, buy, etc. I know one or two people who've done very nicely out of that. Of course, I live in Joburg, so I haven't. But still, it's a really interesting debate. So looking forward to that. You might want to get your view in ahead of Warren or call while we're talking to him on 011 883 0702 and 021 446 0567.
702. Stephen is on X
at Stephen Grootes.
I don't know if you remember the great peanut butter recall of 2024. It was a group of products made by a company called House of Natural Butters. They've been fined 500,000 Rand by the National Consumer Commission. Their products were recalled, and there was an interesting sort of footnote to the story that suggests that what happened was they were transporting ground nuts and some of their products from Zambia and Malawi, which I imagine is not that easy to do. I mean, you look at all of the fuss and shouting and screaming around trucking on our roads at the moment, and that's kind of part of that dynamic. I'm sure that's how they were doing it. It's how I would have done it anyway. But it seems that they didn't have the right certification for the trucks and the transport that was being used. Has anyone been involved in doing that? What kind of certification would you need to have? I mean, I wonder if they'll just take the fine on the chin and sort of move on. Maybe they have insurance for this. Maybe they don't. I don't know. I've never spoken to anyone in the company before, I don't think. But I did just wonder about transporting a type of food, a groundnut, from one country to the other, what kind of certification you might actually need. If you're in that industry, please, voice notes on 072 702 1702.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app
and DSTV channel 856.
Green economy. Well, there's been the most interesting and the most important sort of fracturing process underway in terms of how companies are approaching climate change. A lot of this, of course, is to do with the Trump administration, which in one case, as I understand it, is even acting against some companies and fund managers that were trying to move away from coal and other fossil fuels. Bridget Burnett is the executive head of sustainability at Nedbank. Bridget, good evening. It wasn't long ago when most companies in most places were talking about how green they were. Now it's a lot more complicated. How much more difficult is it for a company to navigate now?
Good evening, Stephen, and thank you for that really good question. I think that we are sort of facing, as you describe, quite a fragmented global order, and we see a lot of diverging policy commitments, some withdrawing from commitments and others doubling down on their commitments. And I think it's important within this space that we're operating in to really understand the sort of tug of war that one faces as a corporate between short-term economic pressures and the longer-term sustainability imperatives for resilience. And we as Nedbank have seen, in fact, quite a lot of corporate South Africa really staying committed to their longer-term sustainability objectives, really understanding the imperative for growth for our economy, but growth of a different type that is more inclusive, that is generative, and that is resilient. So it's been interesting to see that despite sort of global political sentiment, there is a lot of recommitment of purpose-led business that we've noticed.
If I was going to argue within a company, maybe at an AGM or something, against going in this direction. Now, I'm not, Bridget, for a second, but if I was going to make the argument, I would probably say a change is going to cause us short-term pain because the global outlook is so uncertain, because it's so volatile, not just in terms of climate, but in terms of everything. This is the wrong moment to do it. I'm sure, despite what you say, there are some companies that are actually just thinking again, not because they've maybe changed their view, but because they can't be sure that actually they will survive the process because so many other things are going on at the moment.
I think that's quite correct. I think that a lot of companies are reconsidering perhaps the trade-offs of sticking to shorter-term commitments and managing to address some of their real operational challenges and balancing that with the investment required for the sort of longer run. So there definitely is a lot more focus on that trade-off, but I think there's also an important realization that as businesses and banks in particular, we play a fundamental role as part of a system, and, you know, there will be sort of consequences of not moving at pace in addressing some of the sustainability challenges that we need to also consider. So there's a cost of action currently as well as a cost of inaction for future growth. And, you know, there's a lot more considered thought around that trade-off and what that could mean for business.
I mean, the problem is that we kind of don't really know what's going to happen. And, you know, in 3 years' time, maybe the US goes in another direction. I mean, I'm always astonished about how, well, I'm not astonished, but how much green power is generated by Texas, of all places, when you have a Trump administration. The longer-term economic imperative still holds, I suppose is what I'm trying to say.
Absolutely. And I guess it is a world of a lot of flux and a lot of change and uncertainty. But I think sort of grounding oneself in the systemic imperatives helps to manage through some of that uncertainty. And investing for the longer term definitely seems to be still top of mind for economies that are relooking at and how they shape themselves. You know, I do think things such as the success of South Africa's G20 presidency is also likely not to be measured in declarations, but really measured in whether the architecture of the finance system starts to shift towards a model that is fairer and that is really fit for the climate era. So I do see quite a lot of focus on addressing things such as Africa's climate finance gap as a critical part in enabling our just transition, despite some of the uncertainties that you mentioned.
Bridget Burnett, thanks very much indeed. The head of sustainability, the executive head of sustainability at Nedbank.
WhatsApp Stephen
on 072
702
1702.
Well, time to find out what's been happening on our continent. Dr. Rotendo Ndwingwi, founding director at Tribe Africa Advisory, author of Rumble in the Jungle Reloaded. Rotendo, how's it? Good to talk to you again. Botswana cutting back on diamond production amid weak global demand. I mean, this explains why Anglo is trying to sell De Beers.
Good evening, Stephen, and a good evening to your audience. Yeah, and it gives a sort of another sense of reality to that statement. Diamonds are not forever. Obviously, we usually say diamonds are forever, but the dynamics that are happening from a global geoeconomics perspective, Botswana is getting a bit of the knock. Diamonds contribute probably 80% of their export revenues, Stephen, and 2025 year-on-year growth has dropped by 16%, which is quite significant. Key players like Botswana are taking a huge knock. 90% of the exports of diamonds, of the production of diamonds in Botswana comes from them. And this is largely because of the increase of lab created diamonds. And as a result of that, it's impacted the demand and supply of diamonds in terms of the genuine diamonds that are created. And everybody's taking a big knock of this. And I think it's a reality check as well for the new leadership in Botswana. They structured some good deals with De Beers around diamonds. But the reality of the formalities of the past in terms of infrastructure investment and investments made towards diamonds is taking a bit of a knock, and this trend is going to continue. And one of the key things or the reforms that the president of of Botswana has initiated, Stephen, in terms of trying to resolve this. He said, look, instead of exporting raw diamonds, let us polish and cut them locally, and hopefully that will contribute to employment and probably give a bit an up from an economic perspective. The outcome of that is still to be seen, but a big concern for Botswana, and obviously pushing them in terms of the whole discussion around diversification of their economy.
There's quite a lot to look at this because, Botswana's recently undergone a political change. They've needed to diversify for a very long time. Like us, they have very high youth unemployment, one of the highest in the world. Not as high as ours, but close. There's a lot to do to grow that economy.
No, there's a lot to do. They've also got on the agricultural sector with regards to ranching and obviously cattle breeding. That's also a big thing. But 80% of your, if 80% of your export revenue is coming from one sort of product line or one commodity, that in itself is a big scare. When things are on the up and the price of commodities, especially diamonds, is on the rise, then it's a good thing. But where you are now, it's a bit of a huge headache for the president and his leadership, because obviously they've inherited this economy. There's only so much you can do in terms of influencing the global geoeconomics and geopolitics. So it really forces you to double down in terms of the diversification strategy as an economy and see the alternatives. So a lot on his plate. And the reality right now, as I've said earlier on, diamonds are not forever under the current circumstances, unfortunately, for Botswana. So hopefully they'll come out of it, and alternative options will come with regards to finding a solution.
We've been talking a lot about smelters recently for various reasons. And in Liberia, there's a new iron ore beneficiation plant. It's got 1 million tons. Where's the electricity coming from, and can we have some?
It's actually 20 million tons, and they've teamed up with ArcelorMittal. ArcelorMittal, as you know, headquartered in Luxembourg, but one of the big iron ore smelting industrial bodies in the world. Mr. Lakshmi Mittal, who's the executive chairman of ArcelorMittal, actually went to see President Boakai of Liberia to invest in this. So they're looking at growing this from 20 million tons going to 30 million tons. So it's a huge investment. It's about $1.8 billion. And this is actually phase 2, Stephen. Phase 1 was probably about $1.2 billion. So a total of about $3 billion. In terms of employment, this new phase will probably add another 3,000 people it's not actually 3,000, it's 5,000 people, and 1,000 of them will be contract people. So it's quite significant to Liberia. As you know, it's a small economy, small GDP, and has a sort of a harsh history, and they're trying to come out of this. But I think the exciting thing is that, Africa is expected by 2025 to have its industrialization, this is according to the African Development Bank, Stephen, to have its industrialization grow by 3.6 times from 2005. So the industrialization value of Africa will be $1.7 trillion by the end of this year. And this comes out from such foreign direct investments, such initiatives where the private sector collaborate with the governments in terms of creating jobs, but also in creating entities like this that are leveraging off the commodities in Africa, but also streamlining it from an industrialization perspective. So it's a good story to behold. The question is, where does the power come from? I'm assuming it's a lot of coal, but there are also a lot of key initiatives happening on the continent, even around renewable energy and nuclear energy as well, where it's affordable, but that's more long term. So another good story, but at the end of the day, $1.8 billion into the African economy is not a bad thing in this day and age.
There's going to be a new kidney transplant facility in Dodoma.
Yeah, Dodoma, the hospital itself is in Tanzania, named after Benjamin Mkapa, one of the former presidents, if you recall, Stephen. And why this is so important, Japan does a lot of investments in Africa, but because of this, Japan's investments in Africa are very focused and very particular. They're not like the Chinese, they're not like the Russian, kind of sniper shots as opposed to machine gun. And they've teamed up with Tanzania to build what will probably be the biggest kidney transplant facility in sub-Saharan Africa. The total value is about $12 million. Why is this so insignificant, Stephen? Well, one of the key things is, remember, our health deficit in Africa is quite huge. So just to give one of the key indicators that is there, the doctor-patient ratio as recommended by the World Health Organization, as a standard, is 1:10, is one doctor to 1,000 people, just at a high level. On Africa, on average, we're at 1:10,000. So you can see the huge discrepancy globally. Some of the advanced economies like the US and the UK are at 1:500. So you can see the gap that is there. So when you have these kind of facilities being invested in Africa from a health perspective, in terms of infrastructure, in terms of solutions, leveraging of technology, they do make a significant impact, because obviously the stronger and healthier working body we've got of people, the better economic impact and the less of an economic burden that we've got. So this initiative has been signed off. The location is Dodoma, is in Tanzania, another small country making huge impact. But again, Stephen, it talks to the whole issue of Africa trying to resolve problems on the continent, but leveraging off global investors, which is a good story to tell, which in this case is a healthy story to sell. Excuse the pun, Stephen.
And then Sierra Leone has launched the first renewable-powered 5G network.
Yeah, and maybe this is an indirect answer in terms of where's the power coming from. And Sierra Leone, also another country, West Africa, that's had challenges in the past, both from a political and the social perspective. They've launched their first 5G network using renewable energy. They've invested in solar power, battery storage, and obviously generators, fuel generators, in terms of just as a backup solution. Why is this so key? Because obviously the penetration at the moment in Sierra Leone is about 20%, which is quite low. But through this 5G network, it will promise lower latency. It will support smart cities, which is on their roadmap with regards to developing the country. Key sectors that they want to impact on is the health services. And the educational services. So again, you're seeing in African countries investing in terms of trying to find practical but sustainable solutions in terms of not only developing the economy, but also leveraging in terms of making the right carbon footprint. Having said all of this, though, Stephen, when it comes to the bad boys of carbon footprints on the world, remember Africa only contributes 3% of the carbon footprint from a global perspective. So, but still, solutions like this are sustainable and affordable, and that's another key component in what Africa needs.
And Dr. Rutendo Ndwingi, thanks so much. Founding Director at Tribe Africa Advisory, author of the book Rumble in the Jungle Reloaded.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking. Absa is a proud lead sponsor of B20 South Africa 2025.
The Money Show.
Personal Finance with Warren Ingram.
Well, Warren, this evening we're going to be talking about when you should buy your home and when you should rent it. Warren, good evening. Before we start, let me just get something out the way because I'm sure it's going to come up. I have bought my home. When I say bought, I am paying money to the bank for it every month and still will for some time. Just so you know where I stand on this side of the equation. So don't be surprised if I nudge things along in that direction.
Thank you for your full disclosure, Stephen. I appreciate it. I mean, I think it's such a tricky topic because there is a huge amount of emotion involved in this, and not that we should discount the emotion. I think there is tremendous value in recognizing that a lot of us find stability in owning a home. And that stability has a real value. And so, you know, sometimes you don't make the very best spreadsheet financial decision, but you make the best decision for yourself and your families. How's that for sitting on the edge?
Well, yes. I mean, the other thing is, and I don't know if it's the case in other countries, I think it may be, but the generations that came before us were very much buy property. And you can understand why, because in their time, the price of property rarely only went up.
We have a massive fixation on property as South Africans. And what's interesting is we seem to export that fascination when we go overseas. So you see a lot of South Africans all around the world, and it's very normal for them to be on the property ladder as fast as they possibly can once they get to wherever they decide to move to. And very often they'll be strange in that country. They'll be unusual from the perspective that people in those countries, especially in the north, will never own a home. They'll rent for decades at a time, and they'll find it strange that people come from South Africa and buy. And I think that our parents and grandparents would have said, you're crazy to pay off a landlord's mortgage. Why are you doing that? You should always own the place you stay in, and doing anything else is silly. And I think that that's a view that certainly 1, 2, and 3 generations ago that they would have felt that very strongly, and anybody saying something different would have had a hard time, and probably would have been up there with believing in UFOs if you said I'm happy to rent for the rest of my life.
Okay, let's get into it a little bit. Some of the reasons not to, and some of them are to do with the cost of ownership, which I can confirm for you is higher than you might think.
I'm sorry to laugh. It's understanding that when you buy a home, most of us, if we buy a house, we might not buy a freestanding house in a suburb. We might end up buying an apartment in a body corporate, and especially for new buyers, first time buyers in a home in a body corporate, you might be thinking, well, that's fine. I don't have to worry about maintenance at all. I'm going to buy the house or the apartment, and I'm going to pay a monthly levy to the body corporate and my electricity and my water, and then everything's fine. That's not true. What we need to understand is that whether you own a freestanding house or you own an apartment, there is always maintenance. Whether it's the inside of the place, which needs to be repainted and maintained on a regular basis, or when you need to look at something like a special levy, because if you're in an apartment building, unfortunately that needs to get repainted as well, and that money doesn't come from the sky, that comes from you as the owner. And a lot of body corporates don't budget for this. So what happens is every 5 or 8 or 10 years, you suddenly get notification after an AGM that you are now paying a lot more money every month for your levies because you have a special levy. And so those kinds of costs tend to accumulate. And it's crazy when people move into a house. Let's just talk about a freestanding house. Even if it's a great house and you were clever in the way that you bought, it's just funny how things tend to fall apart. You could be in for 6 months and the geyser bursts. So the ownership costs are much more than you would think. And in contrast with a tenant, for example, when you go and rent a place, all of that is the landlord's issue. All you've got to do is pay your rent, make sure that you pay the electricity and the water, and everything else that goes wrong is an email, a WhatsApp, or a phone call away, and you then get an unhappy landlord who has to deal with that.
I mean, the other thing, and we really mustn't forget this, is that the cost of transacting in property, and it's easy to forget this, is actually very high. Buying and selling there are lots of costs that come along with it that are sort of government costs. You can't avoid them.
You're paying, just to kind of list them, without giving amounts for everything, but you're going to pay a form of tax called a transfer duty, and unless you're buying a low value property which falls below a threshold, you're going to pay the bank if you've got a bond. Almost all of us are going to have a bond, so you pay them for registering the bond on your property. You pay the lawyers for conveyancing fees. You pay bank costs over and above the bond registration. Then you pay administration fees. So for a home, and I just did a quick calculation, for a 5 million rand house, those costs all in could be somewhere around 420 to 480,000 rand, and that's not going to improve the value of the house. In other words, it's not like you've just painted the place or put in new built-in cupboards or something. That's gone. That money is just a sunk cost, and it doesn't add a cent to the mortgage that you now have and all the other things that you're going to do. So transaction costs are very high, and important to remember that if you want to sell the property one day, you're most likely going to pay an agent to sell the property for you. And nowadays that cost is somewhere around 2.5% to 5% of the value of the property. And if it's an expensive property and you've done well out of the capital growth of the place, you most likely might pay additional capital gains taxes as well. So going into a property and selling the property one day, it's really expensive.
How important is time in the house then? If you're going to have this conversation, you're going to decide what you're going to do, how important is the amount of time you're going to spend in the house?
Well, I think let's take that. Just say 480,000 rand as a transaction charge. The longer the number of years that you stay in the property, the better. Because if you stayed in the house for 3 years and then you sold it, you're only getting 3 years worth of benefit for your 480,000 rands worth of costs that you've paid just to go in. And then you're going to pay a whole lot of money on the way out again to the estate agent. So what you want to do is limit the amount of transaction costs that you're going to pay. And the best way to do that is stay in the property for a very long period of time. And so spreading out those initial costs and the exit costs, over a decade or two would be a much better idea, because then your costs are just much lower. But the second thing is, now we get into the difference between renting versus owning. When you rent a place, the landlord is going to give you an escalation on that rent every year. In other words, they're going to say to you, you're paying 10,000 rand a month now. In a year's time with inflation, you might be paying whatever it is, 10,000 plus another 1,000 or another 2,000. And that will happen year after year after year. Your rent will never flatline unless you're in an area which is going down, and most likely then you'll want to move. If you contrast that with someone who's buying a house, and if they've got a mortgage or a home loan, what happens there is they have a rate of interest, and as long as the interest rate stays the same, their monthly repayments into that home loan will remain the same. And on the calculations I've done, and I've done this lots of times, but I know it's boring, but I do it for fun sometimes. It seems to me that on all of these calculations, if you stay in the house for a period of 8 years or longer, then it starts to work in your favor to be an owner and not a tenant. But if you're going to rotate properties more frequently, then, and let's say every 3 to 5 years, I can't really come up with a good case for being an owner. It doesn't make sense to me.
Okay, so then under these circumstances, when is renting the sort of right choice? When does it make sense to be that person who's renting and sort of contributing to the owner's mortgage?
So let's think about a few life stages. So the first is we start our working career, and if you are like me, your working career means that all you can afford is not even a one-bedroom place. You can afford something which is a bedroom, a kitchen, a bathroom, and all in one place. And so you stay there for a period of time, and then hopefully, if the career goes well, you get a bit of an increase. You can afford a bit more rent, and so you move into a bigger place. And if you're going to do that in, let's say, 3-year stages, and that seems to be the norm, then it makes no sense to buy any of the first few properties because you're going to be moving so frequently. And so there, at that stage of life, being a tenant makes a lot of sense. The second stage of life is maybe later on, when you've got the family home, potentially you've had children, they've left the house, and you're starting to consider what to do next. I think a lot of the time there, you want to, potentially change at least suburbs, if not cities. And if that's the case, then don't buy the place on the other side straight away when you sell the family home. Then you need to be a tenant again, because you need to figure out where you want to be, what's the ideal size of place that you want to live in. And certainly later in life, I find older people want smaller houses. They don't want the maintenance hassles that Stephen's going through right now. What they want is a small garden, or potentially no garden, and not much day-to-day work on the property. In which case, being a tenant for a period of time until you figured all that out, I think makes a lot of sense. And then maybe, because this is the kind of modern world of work, a lot of people don't have a lot of stability in the way that they earn a salary. Not a lot of people are just getting a fairly comfortable, predictable salary. They're in the gig economy. And if you're in the gig economy where your salary and your package might be entirely variable, then owning a home becomes highly risky unless you really have a lot of money, because what happens if you go through a 3 or 6 month period where your pickings are slim and you can't afford the mortgage? You can't go to the bank and say, look, it's tough times at the moment, just give me a bit of a break, I'll come back to you when I'm ready. The bank's going to say you owe us money, and if eventually, if we don't get paid, we're going to be forced to go to court and sell your property. And so that kind of stress when you're in an insecure kind of earning environment, I think is far too risky for people to commit to a property. So to me, those are kind of key points here. But time is the big one. I think that's the huge determining factor. The shorter the time, the shorter, the more weight in favor of renting.
We're going to come back to this, and I'm going to give Warren my argument for why I think you should buy in just a moment, and let's see how he responds. It's 11 minutes now to 8 the time.
The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram, of course, with us, and the question tonight is, when should you buy and when should you rent? Warren, let me give you a scenario and tell you what I think the advantages are and why I think home ownership is still so important for so many people, and hopefully not just me. If, for example, you're in your early 30s, you could buy a house on, say, a 20-year mortgage. As you pay off the mortgage, you've bought the house for X. The rate of inflation prices will go up all the time, but the price that you paid for your house still remains at X. That's what you're paying back. And so over time, there should be, and what should happen in a market where house prices are going up and where things are moving normally, the amount of your income that you're paying for accommodation goes down, if you see what I mean. So your bond, what you're paying every month, goes up and down according to interest rate decisions, but inflation continues up all the time. The price of goods always goes up. They never really come down. So that's the one thing. The second thing I would say is, if you buy a house in your early 30s and you live in it until you say early 60s, which I'm sure is a scenario that's happened in many cases, you've probably paid it off within the first 20 years. So for 10 years, you're living rent-free. You're not living cost-free, but you're probably living rent-free. And then the other thing I would add to it is that if you get ahead of your bond, you can use it to finance other things. It's the cheapest finance there is. If you want to buy a car or something, that's a very good way to do it. Those would be my sort of arguments in favor.
I really like the last one. And I think that's it's also a fantastic emergency fund when you've paid off extra money into your home loan, and you know where you can access money in an emergency. And as you say, then for buying a car, easily the best rate you're going to pay, unless you're incredibly lucky. So I like that role that a mortgage can play in your life. The first one around rising property prices. I have some emotional scar tissue from having been a homeowner in Joburg for a period of 9 years, and I did pay the home loan off as fast as I possibly could, and was really enjoying life, living in a paid-off home and enjoying just having to pay rates, etc. However, when it came time to sell that house, I had to sell it at a price below what I paid for it, Stephen, and that's the fallacy of the assumption that house prices only go up. Unfortunately, that's not true. So if it was, we would be okay. I think over a very long period of time, we know that house prices tend to track inflation. That's true, but the house prices move in such a long cycle that you could find, as we're seeing now in Joburg specifically, that house prices. I heard a story the other day of someone who's just bought a home from a person at the same price that they paid for the house in 2007 in a prime area in the northern suburbs. And to me, that's really tough, because when you take into account the value of money, the 2007 price relative to today's price, that's going backwards at a rapid rate. So I'm concerned that we believe that. Maybe the one thing I'd say is, when everybody's terribly afraid of buying a house in a particular city, and there is a lot of negativity. If you have the ability to see through that as a cycle, then you might be able to buy the house at a very low price, and then you participate in a very nice recovery. And that's value investing at its best. Buying when everyone else is selling. I think that could work, Stephen. But gee, I think if we believe that house prices just go up because we read the papers and we see what happens on the Atlantic seaboard, that could catch us out.
Don't you still get 10 years rent-free, though, if you live in a house for 30 years?
You do. I think it's a fair point. So I think it's, and maybe the thing we really should, also focus on is a lot of people simply can't live with the uncertainty of being a tenant.
Yeah.
And having that locked in kind of anchor in their lives is critical to them. And maybe the other argument as well in favor of renting, because I'm a tenant now, so I'm on the other side of the equation from you. But one of the things about, for me being a tenant is there is a day when the landlord could just say, listen, I'm selling, or there's huge demand in the area in which you live, and I'm pushing that price up, that rental price at a lot more than inflation. And if you don't like it when the contract ends, unfortunately, you need to move out. And I think that's that's a instability that a lot of people won't enjoy, and it will make them make incorrect financial decisions in other parts of their lives. So I think it's, I know I'm sitting on the fence a little bit, but I think we can make good financial decisions which don't fit in the spreadsheet. So I'm not saying that you've made the wrong choice in being a buyer, but I think the kind of just get on the hamster wheel and buy the property because that's what's always been done. For me, that's a really poor way of making decisions now. We need to be very considered in this, and understanding that, whatever you do, the home ownership, it's going to be expensive. It is a cost, for your life. It's going to be an expensive item to own, especially where property ownership costs are rising much faster than inflation. And where we see that is refuse collection, those kinds of things. The small little taxes that we think are not big items are going up sometimes at 15 or 20% a year. And that's going to catch people out, in the months and years ahead.
So, what you really want to do is try and work out over time what the cost of accommodation is over 30 or 40 years, and you've then got to sort of spreadsheet that and try and work it out from there. It's quite complex to do. Most of us don't know how many children we're going to have, but that's actually the way to do it, is to be quite as rational as that is. That's what you've got to try and do.
Yeah, and often, it's good to bring out the children. I think parents of young children, when they make the decision to choose a school for those kids, that could be a decision that locks them into a particular area for 7 years or 7 plus 5, depending on whether you want them to stay in the same area for both junior and high school. And that's a great time to be a buyer of a property, because you know exactly where you're going to be for that time, and you've got a great reason to be there other than just preference. So to me, then buying almost irrespective of the price makes sense. And schools and educational institutions are often a great anchor for properties in general. If you look at the areas around very good Model C or the old Model C schools all around the country, those areas tend to stay fairly high value areas because parents need to be close to get those kids into those schools. And I think that's a very good argument for property ownership as well.
Warren Ingram, I've thoroughly enjoyed this. Thank you so much. Really do appreciate it. Co-founder of Galileo Capital, and need I remind you, a certified financial planner. Your views. The conversation, of course, will continue.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking. Absa is a proud lead sponsor of B20 South Africa 2025.
Well, that's it for this evening. We, of course, will be back with you tomorrow. Lots going on at the moment. Good evening. It's 8 o'clock.